You're probably thinking about purchasing a home, and like most Americans, going to be utilizing a mortgage to purchase a home. Mortgages are great products, and they really do make home ownership so much more affordable for most people. But when it comes down to mortgages, there's a lot that goes into qualifying for a mortgage and also your buying power and how it's affected. One of the biggest ones is credit itself. So today we're really going to dive into credit. We're going to talk about your credit score and the minimum requirements for certain loans. But also we're going to talk about your credit history and utilization, because this is probably one of the biggest effects it have on your mortgage application and buying power. But don't worry, we're going to give you some tips on how to improve that and also strengthen it so you might be able to afford a little bit more home. Hi, I'm Jaketysiak, that guy that sells houses, and credit is such a fun topic to talk about. Sarcasm, but also a little serious. So there's a lot of ways that credit does play into our lives, and when it comes down to purchasing a home, credit score is one of those things that people often look for because there are minimum requirements for what credit score you have to qualify for loans. So your traditional conventional loan starts at 620 minimum credit score, and if you're above that, you can qualify for a conventional loan. But just because you don't necessarily have a 620 doesn't mean there's not other options. If you're below a 620, consider an FHA loan. Now this is a loan that is guaranteed by the government, so they give you a little bit more leeway. Traditionally, you are looking at a 580 credit score or above, and you can put down as little as 3.5% with these programs. However, if you have a little bit more down payment, say 10%, you can actually see your credit scores from about 500 or above. So that does definitely give you a few more options when you start to look at different products and where your credit is at currently. Now these are some minimum requirements, and of course the higher credit score you have, the better chance of you getting accepted and also a better rate. But when it actually comes down to a lot of the terms of the mortgage itself, that has a lot more to do with your credit history and also your income, sort of how these two talk and communicate together. So what I mean by that is what banks want to look at is to make sure you can afford the mortgage. So one of the things they're going to look at is your debt to income ratio in regards to your mortgage. So oftentimes, they don't want to see you spending more than 28% of your gross income, so before taxes are taken out, on your mortgage. And this makes sense because obviously there's a lot of things that go along with owning a home, and there are some flexibility in this, but 28% of your current income is a good number really to base on what your monthly payment would be. Now I said monthly payment. And this is a big thing to keep in mind. I know most of the time you're focused on the purchase price, but ultimately what banks are really looking at is how much you can afford monthly, and that can affect your purchase price a little bit based on taxes, insurance, and so forth. But keeping an eye on that payment is a great way to start off by focusing some of our attention today, because there's some ways that we can help improve this as well. Now when it comes down to debt to income ratio, it's not just your mortgage payment that they're looking at. They also want to know about your other debts that you have. Other debts might be a car payment, credit card balances, student loans. These all come into play as well when you start to look at a home mortgage, because home mortgage is so significant. So oftentimes what they want to see is all of these other debts along with the mortgage payment not exceeding 36% of your total income gross again. Now each bank will have a little bit different requirements, but this is really a great rule to stand by. Because now we're going to shift our attention to really how we can strengthen our mortgage application. But the nice thing is there's a way to boost your credit score and help out a lot more when it comes to your mortgage itself. So going back to our credit cards, one of the things I talked about is how we utilize credit. And one of the biggest ways that our credit score is affected, and ultimately to a degree, our mortgage application is going to be affected, is by credit utilization. Let me explain a little bit more. So if you have a $10,000 credit currently, and you're using $6,000 of that and carrying a balance, they're going to be looking at that as you're utilizing 60% of your credit history, or credit availability, I should say. And this is going to hurt your credit score. Traditionally, they only want to see about 30% credit card utilization when you're comparing it to your available balance. And this is really going to help improve your credit score. But if you can decrease your credit card balances, there's a good chance you're going to be able to afford a higher purchase price. And that's going back to our credit card payments. So obviously, credit card payments, your monthly minimum payment is dictated on your balances, and they shift all over the place. And by lowering your minimum payment, this is going to reflect on your credit report, and that will also help possibly raise your ability to purchase a more expensive home because, again, they're looking at that 36%. So if we lower the burden here, we can increase our purchase price with the mortgage itself and the house. And in doing this, it's also going to be benefiting us from improving our credit score itself. Now, you might be out there saying, Jake, I already pay off my credit cards every month. This doesn't really help me. But there's a way I can still help you. You see, when you are looking at credit cards and you pay them off every month, say you do rack up $6,000 on that credit card every month, but you do then pay it off when your statement comes. But you see, when it comes down to your credit report and ultimately the way your mortgage is going to look at that, is the statement balance is what's reported to the credit bureaus. So that $6,000 is going to show up as debt that you are actually obligated to pay and that monthly payment associated with it. But there's a great tip for this. Simply by moving your payment from that due date or after your statement comes out to right before your statement comes out, it's going to alleviate all of that balance off of your records. So by doing that, now your $10,000 credit card balance, instead of being $6,000, might only be a couple $100 depending on what you purchased that last day or so. And this will significantly lower your minimum payment and then ultimately help you with your purchasing power and how likely you are to get qualified. And of course, when it comes down to your credit score and lenders, there's a lot of nuances. So it's always best to contact your preferred lender to really go through your scenario. And if you do have questions, or if you are looking at purchasing a house or selling a house, feel free to reach out to me. I would be happy to help. I'm Jake Tysiak with Keller. Thank you so much for watching. I'll see you in the next one.